Good morning, I'm Gary DeWaal, and this is Bridging the Weeks for August 29th through September 9th, and today is September 12th, 2016. Last week, the National Futures Association proposed requiring commodity pool operators and commodity trading advisors to provide two financial ratios on a quarterly basis. However, NFA said it does not want to impose a minimum ratio, but solely to monitor ratios to assess how CPOs and CTAs are doing financially. Separately, the Securities and Exchange Commission awarded its second largest whistleblower payment, $22 million, while the Commodity Futures Trading Commission proposed to update its whistleblower rules to make them more like those of the SEC. I am back from a wonderful vacation, mostly at Rocky Mountain National Park in Colorado, so before the gleam from my vacation soon fades, let's get started. The National Futures Association submitted to the CFTC for its approval a new requirement that would mandate that registered commodity pool operators and commodity trading advisors submit two financial ratios on their quarterly reports to it on forms PQR and PR, respectively. The required ratios would be current assets over current liabilities and total revenue over total expenses and must be calculated using the accrual method of accounting. The NFA said it seeks to obtain these ratios so that it might better monitor each CPO's and CTA's financial condition in order to, quote, identify firms that may be facing financial difficulties, end of quote. In addition, each CPO and CTA must be able to demonstrate how it computed its ratio and retain all financial records supporting its calculations. Importantly stated NFA, quote, it is not establishing any minimum ratio that a firm must meet. Rather, NFA will incorporate the financial information collected on forms PQR and PR in its oversight program and use it to identify trends that indicate that a firm may be facing financial difficulties which could impair its ability to act in the best interest of its customers, end of quote. The Securities and Exchange Commission awarded more than $22 million to a whistleblower for voluntarily providing original information to it that, quote, helped the agency halt a well-hidden fraud at the company where the whistleblower worked, end of quote. This is the second largest whistleblower award ever awarded by the SEC, which now has awarded over $107 million in whistleblower awards since establishing its whistleblowing program in 2011. Separately, the Commodity Futures Trading Commission proposed to amend its whistleblower program to more parallel that of the SEC's. Among other things, the CFTC proposed new procedures to review whistleblower claims, to clarify that the CFTC may bring enforcement actions against any employer that violates its anti-retaliation provisions, and to prohibit any agreement or condition of to prohibit any agreement or condition of employment, including a confidentiality or pre-dispute arbitration agreement, from containing a provision that would, quote-unquote, impede an individual from communicating a possible violation of law to CFTC staff. Comments to the CFTC's proposed amendments will be accepted by the Commission through September 29th. Over the vehement dissent of Commissioner Sharon Bowen, the CFTC determined that the margin requirements for uncleared swaps applicable to swap dealers and major swap participants under Japanese rules are mostly comparable to those under CFTC rules. As a result, such covered swap entities may comply with Japanese law for most margin requirements when transacting with a non-U.S. counterparty where the transaction is subject to both U.S. and Japanese margin rules. The only material difference, said the CFTC, were requirements related to the posting of margin for inter-affiliate transactions, whereas a CSE, or covered swap entity, entering into uncleared swap transactions with a consolidated affiliate under CFTC rules is required to exchange variation margin and in certain circumstances collect initial margin. This is not the case under Japanese requirements. Accordingly, a covered swap entity transacting an uncleared swap with a non-U.S. person that would otherwise be subject to both the U.S. and Japanese margin rules would have to comply with U.S. margin rules related to inter-affiliate transactions. Similarly, under CFTC rules, all initial margin posted or collected by CSE, covered swap entities, must be held by independent third-party custodians. Although this is not a requirement under Japanese rules, under Japanese requirements, all initial margin must be held in the trust structure. The Commission said the Japanese structure was comparable because, quote, property deposits in such a trust account is legally recognized as segregated from the property of the trustor, the property of the trust bank, and other trust property in the trust account, end of quote. Commissioner Bowen dissented from this and other comparability determinations, claiming that, quote, in my experience with bankruptcies, I have learned that access to customer funds largely depends on the location of those funds. Third-party custodianship is an important safeguard, end of quote. Commissioner Bowen also objected that while under U.S. law, variation margin for dealer-to-dealer swaps must be met in cash, less liquid instruments are permitted under Japanese law. Quote, that means, end of quote, said Ms. Bowen, quote, that in a crisis, American companies in Japan could be exchanging instruments that are virtually worthless since they cannot be readily converted to cash, thereby putting them in jeopardy, end of quote. And finally, the Chicago Board of Trade and the Chicago Mercantile Exchange each brought and settled disciplinary actions against Frederick Nielsen, a non-member, claiming that between February 2013 and February 2014, he engaged in a quote-unquote pattern of activity where he would layer orders on one side of a market, quote, without the intent to trade, end of quote. He did this to allegedly induce market participants to trade opposite smaller orders he had resting on the other side of the market. Once those small orders began being executed, Mr. Nielsen purportedly canceled his remaining layered orders. Mr. Nielsen agreed to resolve these actions by paying a combined penalty of $65,000 US and being suspended from access to all CME Group markets for 3 weeks. Separately, both Odds Management LP and Yannick's Management LP, non-members, agreed to resolve disciplinary actions by CME Group exchanges for allegedly engaging in exchange-related position transactions that were prohibited transitory EFRPs. CME Group claimed in both matters that the related position transactions, quote, were not independent transactions exposed to market risks, end of quote. Both firms settled their unrelated disciplinary action through payment of a $15,000 US fine. Finally, Ronald Sipel, a member, resolved the disciplinary action brought by CME by agreeing to pay a fine of $55,000 US and having his access to CME Group exchanges suspended for 10 business days. Mr. Sipel was charged with executing multiple trades for accounts opposite each other where he controlled the accounts on both sides. His intent, said the CME Group, was to transfer positions from one account to another. Well, that's it for this week's edition of Bridging the Weeks. As always, there's more information in each article and more articles on the article version of Bridging the Weeks on the website. Check it out. I'm Gary DeWaal. Have a great week, and until next week, ciao.